Hello and welcome to a special show on Monetary Policy Committee's meeting. I'm Ankur Mishra, and this time Reserve Bank of India's Monetary Policy Committee's June policy comes at a time which is very interesting juncture. Inflation has softened sharply, growth remains resilient, but the macro environment has become far more uncertain. Crude oil prices have surged amid the Iran-Israel conflict and the rupee is under pressure. And global central banks continue to navigate a volatile geopolitical landscape. Will the Reserve Bank of India focus on the comfort coming from inflation, or will it start worrying about the imported inflation risk and financial stability? Let's discuss this with three of India's leading economists. Let's welcome Aditi Nayar of ICRA, Dr. Sachidanand Shukla of L&T, and Sakshi Gupta from HDFC Bank. First and foremost, I want to come to you, Aditi. What are you penciling in for Reserve Bank of India's MPC meet this time? A pause?
Yes, Ankur, thank you so much for calling me on your show. And we are penciling in a pause this time around because inflation is expected to inch up in May, and it's expected to go up more sharply in June, reflecting the full impact of the increases in the petrol and diesel prices that have come in. But overall, we're still seeing this as an exogenous shock. Only once we start to see an impact in terms of the second round, and also once we have more clarity on how the El Nino is going to affect the monsoon and agricultural outcomes, we would expect the MPC to remain on pause in the meantime and only take a rate action maybe later in the year, in the second half of the year.
Dr. Sachidanand Shukla, I want to understand from you, do you think RBI will wait and watch, and more importantly, the focus will be more tilted towards inflation?
So if you look at how things are, the US-Iran war now I think is in the realm of astrology and not economics, right? If you look at how people, most people are still having their base case in days and weeks and not months, right? So we've seen 3 months really go by, and yet most people really are looking at a base case which is just weeks and not probably months. I think a couple of things that I want to put up here. I think the very basic fact is that the pressures are emanating not primarily from overheating demand, but essentially from classic supply disruptions and geopolitical tensions in West Asia. And if you look at the rates markets versus oil markets, the signals are very different. You look at rate markets globally, domestically, they're all pricing in higher inflation, higher interest rates, and whatnot. Whereas if you look at the oil markets, right from the beginning, they have been very, very clear that the long end of the curve there is pricing in some sort of agreement or some sort of a truce. And I think what we should be mindful of here is that we are fearing inflation, but there is no runway inflation as we speak. There is no run on the rupee, and therefore I think the credibility of our macro framework will be on not really avoiding the pain, but distributing the pain wisely via monetary policy and fiscal policy. Therefore, I would think that going forward, the RBI would be cognizant of these facts and will not really resort to any premature tightening. Like I said, we are not seeing runway inflation, we are not seeing run on the rupee, and we know the classic Yang-Tinbergen principle. If we use the short-term policy rate, we might not really be able to say impact either inflation or just the exchange rate. So I think we'll end up harming growth more than really impacting inflation. So back to you.
Right, and overall, if you talk about inflation, it has remained comfortably below 4%, minus the food inflation, which has of course gone past 4%. So therefore, Sakshi, I want to understand from you, crude is at a multi-month high, and which continues to be between $95 to $100 mark. Which variable should dominate Reserve Bank of India's thinking at this MPC?
Right. Good evening, Ankur. Thanks for having me on the show. I mean, I kind of agree with, what the earlier panelists have said. Look, I think that the central bank's policy decisions are governed by, ultimately what's happening to inflation, both in terms of, recent numbers as well as have a sense of, how things are going to progress over the next 3 or 4 quarters. Right, this is where things get complicated because while right now, because of the limited pass-through at the retail level, we are seeing CPI still at 3.5%. Now that might start inching up, according to our estimates, above 4%. So, we've perhaps seen the bottom on inflation, and it's gradually over the coming months. Depending on how factors like global commodity prices, the extent of pass-through at the retail level, the second order impact of fuel increases, and most importantly weather related shocks. I mean, we're looking at below normal monsoon and El Nino and heat waves currently in North India. So how some of these factors play out and whether they lead to a sustained or more durable increase in inflation, I think that is important. And therefore, at this point in time, I would kind of, I have a similar view that the central bank looks at domestic macros and says, do we really need to, hike the policy rate? Not at this juncture. If inflationary pressures become more durable, and only in that case, I think that there will be space for them to then consider and look at rate increases. But that's a story only, I think, by the October or December policy meeting. I don't think that interest rate hike at this point where global yields are increasing so sharply that interest rate hike of 25 basis point is going to benefit the rupee or change our interest rate differential materially. And therefore, I think the focus remains inflation and growth.
All right, focus is definitely inflation, and that is MPC's mandate too. But Aditi, how much of the current crude shock is likely to pass through to Indian consumers? Any estimate you have done?
Look, the crude oil price itself has been very volatile and it has cooled off a bit in the last few days. So we need to first hope that this is going to be a sustained easing and, not really keep 105 per barrel kind of pricing in our framework for the time being. So I think we have to really wait and watch and see if more price hikes are required and to what extent. If crude is going to be in this 95-ish kind of range now instead of 105. Now, once the price increases have gone through, I do expect them to be sticky. So I would not expect that prices will come down on the RSP side very quickly because obviously the ONCs would have made a lot of losses that, they would also need to recoup at some point in time. So this is now the level, the RSP increases that have already happened is what we built into our inflation forecast for FY27. And as of now, I agree with Sakshi, we're looking at inflation crossing 4% in the next print for May. And then going up further and crossing 5% by July, August. Then, of course, the El Nino impact will start kicking in and we have to bake that into our forecasts subsequently. For FY27 as a whole, at present, we are looking at a CPI inflation average of 5%. So it is above 4%, which is the midpoint of the MPC's target range. But, it's at the midpoint of the upper end of the range. So it's, squarely between 4 and 6. So at this point in time, that's probably something that, we can live with, given the fact that the crude oil price increase is an exogenous shock. El Nino also in itself is exogenous. None of this indicates that demand conditions are overheating by any means. And I totally agree that, both of these shocks, the fact that West Asia has pushed up crude prices, which have eventually pushed up RSPs, and the fact that an El Nino may lead to lower agricultural output and income and higher inflation, all of these will anyways constrain demand. So you don't really need a monetary policy action at this point in time to exacerbate what will already happen.
Right. And if you talk about inflation, Mr. Shukla, is the bigger risk today inflation itself or inflation expectations being unanchored?
So I think as we speak, any impact really on the macro variables, whether it is growth, inflation, CAD, or even the FIS, is going to be dictated essentially by how and what the policy choices are. And this policy choice will determine the distribution of the impact on inflation, the FIS, and things like that. So as we speak, I think everybody is really guesstimating these impacts. And the point I want to stress here is that an extended conflict and oil prices above 105, I think are the danger mark for me. Oil prices, if they remain at 105 per barrel, that will lead to growth really coming down below 6%, and inflation, CPI, most people are around 5%, it will cross that. So I think the growth inflation metrics begin to really revert or become really harmful in terms of the scenarios. Another thing that I want to point out is everybody's forecast, and especially RBI, they're looking at 4% in Q1, 4.4 in Q2, and the peak is Q3, right, which is about 5.2. And then they're expecting inflation to ease to 4.7 or thereabout in Q4. But like I said, if you look at how inflation has behaved, whether you're looking at core, which is flat at around 3.4% for 4 months in a row, or 4.4, or whichever metric you look at, the point I'm making is the decisions going forward, the policy choices that the government really makes, monetary and fiscal, will actually determine the impact on inflation. So whatever numbers we're discussing, I think are too premature. And only if crude oil prices remain north of 105, I would begin to worry on that. Otherwise, like I said, everybody's base case still is days and weeks and not months. So it is, I think, premature to really worry too much on that. Yes, going forward, the growth and inflation scenarios can really become adverse depending on the prices and the convexity. That is the most important factor here.
All right, so 105 is the benchmark or the danger area which Mr. Shukla is highlighting. Sakshi, what is your assessment of RBI's inflation forecast? Does it now look too optimistic currently, because last time when monetary policy was announced, on that day only true stocks actually begin?
No, I see where you're coming from. Look, the last forecast that we had was in the April policy, and honestly, at that point, we were thinking that, okay, look, oil maybe averages around, and the central bank's forecast was that oil averages around 85, and perhaps there's, that implicitly assumes that there is some near-term resolution to the conflict. Now, we are 2 months, down from that policy meeting, and therefore, we've also, from our earlier forecast over the last 2 months, have revised up our inflation forecast. So I would say, yes, at this point, the way I'm seeing things, if I assume oil to be, averaging around $90 per barrel for FY27, we have an inflation forecast of 5%. And that takes into account the increase in petrol and diesel prices that has already happened. However, there is still upside risk to this forecast because, we are unable to factor in any weather-related disruptions and what sort of impact that could have on food inflation. Right. So from that point of view, yes, I think at this point, 4.6, which is the RBI's forecast, does look a little bit on the lower side compared to what, market or what we are predicting at this point. But, it's an inflation is an evolving forecast for this year and completely depends on, a number of events and variables like we discussed, both West Asia, commodity prices, second round effects, weather, monsoon. I mean, how these things are going to pan out. So I think we will see further revisions on inflation, over the coming months.
Definitely, and that is something to be watched out for. But Mr. Shukla, rupee is trading near record lows. In fact, if you compare with last month, we have recovered. But how much does currency weakness complicate monetary policy according to you?
I think it's been the variable that's borne the pressure on the external side. We're down around 12% in a 12-month span. But I think if you look at how things are evolving lately, a lot of other currencies have been under pressure. So I would not really worry so much on depreciation per se, but it is how orderly or disorderly it is. And I think there are multiple things that the RBI can look at, and I would expect the RBI to be more nuanced. I think credible communication, liquidity management and targeted forex operations rather than the blunt use of say interest rates. I think that could really help. And like I've been saying in the past as well, the rupee behavior is also likely to be dictated by the policy choices on the non-monetary side. So fiscal policy, trade policy, a lot of measures need to kick in. And while the RBI has certain policies in its toolkit, I think primarily the rupee behavior could be dictated by non-monetary measures, which could probably take a bit longer. Right now, I think it is the RBI's domain to ensure that the rupee movement is orderly whichever direction. So I would not really worry so much on the level of the rupee. In the short term, given the kind of market pressures, given the kind of uncertainty, the rupee will have depreciation bias. But I think it should be orderly, it should really be managed well, and I think RBI has all the tools necessary for making that orderly movement on either side. So I would not really be worried so much on the rupee level. But this is something that I think is one of the most important monitorables apart from the inflation numbers going forward.
Okay, but a standard communication from Reserve Bank of India has been that they do not watch any kind of levels. However, the excessive volatility is something which central bank is watching. But Aditi, can RBI afford to ignore the exchange rate while setting policy, or does the rupee now become an important policy consideration according to you?
Look, as far as the MPC itself is concerned, I don't think that they're really going to be looking at the rupee, because that's really not part of their mandate within the flexible inflation targeting framework. The RBI, yes, but MPC, no. So I think whatever measures the RBI will take will be separate from the MPC announcement.
Definitely. Coming back to the inflation part, Sakshi, do you think we are underestimating the impact of imported inflation through fuel, freight and commodity channels?
Right, not necessarily so. Look, the imported inflation channel is actually stronger when you look at WPI inflation, right? And that is actually showing up in terms of, WPI inching up to 8.3%. That is the last print that we have. However, when we start talking about retail inflation, it really depends on what is the extent of pass-through, right? So then that's where things start becoming complicated. It is not as direct as, okay, rupee has depreciated so much and oil prices have gone up by, 10-20%, and therefore that's the pass-through on inflation that's going to happen. I think the critical element here to watch out for is, one, what is the extent of pass-through that producers are comfortable with, right, as input costs are going up and their margins are coming under pressure. So far, we are not seeing evidence of a generalized increase, in retail prices or generalized pass-through at this point. That is point number one. Point number two is, of course, on the petrol and diesel front. Initially, there was very limited pass-through. Now we've seen an increase. I think if, as Aditi was saying, if oil prices remain elevated, then perhaps some more increase in prices, pump prices can come through. So, at this point, it is not a very linear relationship between what happens to the rupee and what happens to, inflation, retail inflation. Of course, there is a correlation, but I think the degree of impact actually depends on a number of variables, as I pointed out.
And Aditi, the last data release which has come today is in the form of IIP, which is 4.9%. How do you think Reserve Bank of India will be reading this data?
So, I'm going to tie that back to something that Sakshi just said. My view as well is that firstly, as far as our domestic economy is concerned, right now this is a supply shock, it's not a demand shock. That's what the high frequencies were telling us. And I think that's broadly what the new IIP has echoed as well. My sense is that for a lot of companies, because again, the mindset has been in days and weeks and not months and quarters, possibly people will have wanted to let margins take a hit in Q1, but let the volumes be protected. So that will both keep inflation, prevent inflation from rising very sharply in Q1. And it is also something that will protect the volume side and protect the growth side. So that's broadly what we expect. That it's margins that will come under pressure. So in your GVA terms, when we eventually get the GDP data for Q1, you will see a hit coming in because the value added will be lower because margins absorb the pressure in Q1. So we are, as of now, penciling in a sub 6% growth for Q1. And we are not expecting any kind of big uptick in Q2 because in Q2, the price impact will kick in. The disposable income impact will kick in a little bit. So that will sort of counterbalance things even if the conflict was to end completely tomorrow and commodity prices were to cool off, because in any case things like crude oil will take time to cool off, and once the RSPs have gone up, they're not going to reverse very quickly.
All right, last few minutes remaining in the show. So I'm going to do a rapid fire round with each one of you. First and foremost question we have already dealt with is whether or not there is going to be a pause. But more importantly, I want to understand, do you think the stance will be same? First, Aditi.
Yes.
Mr. Shukla?
No change in stance, nor the rate.
Sakshi, what is your view?
No change in stance.
All right, so we have a unanimous view on the stance on whether or not Reserve Bank of India is going to hike rate or a pause. Everybody is saying a pause here. Let's also understand what is your inflation forecast. Each one of you is thinking it is going to be more than 5% for FY27. Sakshi?
Yes, my forecast right now is 5, but I think it will be more than 5%, I agree.
Mr. Shukla?
5.1 for now, but like I said, it's all conditional and it will keep evolving as we move forward.
Right, and Aditi, what do you think?
5% for now with an upside because of moderate to strong El Nino.
All right, the last question to everyone is whether or not there is going to be tinkering in the growth forecast. What is your estimate, Aditi?
My current estimate for crude oil at $95 on average in FY27 is 6.2%. So I think there will be downward revision in the MPC's growth forecast.
Mr. Shukla?
I think growth could be around 6.5 to 6.7%. And I think there is some revision to be made from the RBI when it comes to the quarterly distribution forecast that they have, both for growth and for inflation.
Sakshi, what is your view?
So my inflation forecast is close to 6.7, 6.8. This is assuming oil averages between $85 to $90 per barrel. I don't think that, my expectation is that they will keep their annual growth number for this year unchanged for now. And maybe only in the August policy we might get a change on the growth forecast.
All right, thank you so much from each one of you for joining at this hour with your views. And more importantly, we have a kind of a unanimous house where the expectation is that there is unlikely any tinkering on the rate front from Reserve Bank of India. The stance is likely to be neutral, and more importantly, there is likely to be a revision in the inflation as well as growth forecast. Thank you so much for joining viewers for this special discussion.